Hi guys, welcome to this month's webinar on is the property market dead? It's something that we're getting asked constantly, pretty much. It's one of the biggest questions at the moment we get asked just before anyone starts to move forward with an investment. The biggest thing that they're getting asked at the moment, or that we're getting asked at the moment, is the property market dead? What are the signs around the corner? So I felt it was good lockdown. This was predominantly one of the increasing questions that we got. So I'd like to sort of address this. I feel that what we can do is we can establish what happened in the previous dips. That gives us an indication about will there be another dip, and also where we're at with lockdown. Of course, we've just had a stamp duty holiday. When this webinar was actually written, we didn't actually realise that the stamp duty holiday was there. We heard it muted but around, but we didn't realise that it was going to come in imminently. So there's obviously more to update, which we'll go through. Without further ado, let's kick off. Well, first of all, where do we like to start? Well, we'll probably start back in 2007. Maybe we'll go back a slightly bit further than that. Let's go back to the late 80s, early 90s. The two biggest dips that we've seen over the last sort of 30, 40 years have been the late 80s, early 90s, and 2007 to 9. Now, those periods, the reason why they dramatically dipped as much as they did is simply because in the late 80s to early 90s, interest rates went so high that essentially what happened is people couldn't afford to pay their mortgages, and they actually had a chance of getting a cheaper house, therefore paying back less interest on the mortgage down the road. So it's essentially, there weren't the ramifications then that you get now. So for example, if you gave back your house then, there weren't the ramifications as now. If you gave back your house, the chance of you getting another mortgage within the year is very slim to none. So essentially back then it didn't happen. A lot of people could give back a house, and then not too long in the distant future they could get another one at a far cheaper price, and obviously paying less back on the mortgage. One of the main reasons there was back in the day, the Bank of England didn't control the interest rates. These were controlled by the party in the power. So of course it benefited savers. So if you were a saver at that point, you had great income on your savings. If you had £100,000 worth of savings, you were getting 160 or 16,000 pounds every single year just on your savings account. So for retirees it was great. For borrowers it was a terrible time. However, the most recent one, which we can all recollect, is 2007. So what basically happened in 2007 or 2008, more importantly, is are we seeing the same signs? What were the signs back at that particular point? Now, many people now tell you that they predicted what this was going to happen, or they predicted the dip. Again, very, very few people did. There were a few people that made a lot of money out of the dip, but very few people actually predicted what was going to happen. The reason being is that a lot of people didn't realize how weak a lot of these loans were, and by that there were a lot of loans that were given to property purchasers, and really they just really weren't qualified to have a loan. Their job was probably temperamental at best. They probably didn't have the 3 to 6 months worth of pay slips that they ask for now. You could also self-certify, so you could walk in and say, right, yeah, this is what I earn, I'm self-employed, this is what I earn, and on the back of that you could self-certify and get a mortgage. All of that has been done. So what happened is a lot of the banks were lending on properties, and as soon as the interest rate started to increase and the mortgage rate started to increase, we saw a big tumble where people thought, actually I can't pay. Because a lot of people think, well, if it goes up 1%, if you're paying 2% for argument's sake on your interest and it goes up 1%, a lot of people don't realize that that's actually 50% extra what you're paying back in interest. They think, oh, it's just 1%, but it's actually 50% extra on what you're paying. So back in 2007, 8, 9, we pretty much had 15 years of straight growth. Throughout the early 2000s, as I say, banks relaxed lending regulations, self-employed individuals could self-certify. As I say, if you think about it now, for anyone now who thinks that they could walk into a bank and tell a bank what you earn and walk out with a mortgage, it's just absurd to think that could actually happen. Now, the relaxed rules meant that it wasn't only these type of individuals, it was across the globe, and that's really what affected it. We hear about subprime. This is an American terminology, the subprime mortgages that we hear. The combination of that, along with the fact that the interest rates started to rise, was deadly. So clients who were struggling to pay back at 3% were now faced with mortgages that were closer to 6%. So like I said, they were essentially doubling the interest that they were paying. So suddenly they thought, I just can't keep up with the repayments. So they just gave the properties back. Now, this then caused another issue with the banks. So banks then were now real estate agents. In Spain, there was one particular bank, and they announced that we are now a bigger real estate agent than we are a bank. They had so many properties on their books that they just needed to get rid of them. So what then happened is, as banks become essentially real estate agents because they owned so many properties because they took them back or they were giving them back, they then started to sell these properties for less, just to get rid of them, just to claw the money back. So don't forget, what they can do is essentially, if they, let's take into account residential property for the moment, because they were the predominant properties that were given back. If a residential property where you put down 10% deposit or even 15% deposit, whatever it may be, is given back, well, the bank can afford to sell that for 10 to 15% lower than the market value, and they would still recoup their funds. So that's essentially what they did. They started to sell those particular properties 10, 15% lower, because for their from their perspective, they could then recoup the funds that they'd already lent out. They'd only lent out 85%. They weren't worried about the extra 10, 15%. They then started to sell them, and this caused a domino effect in the market. So what then happened as the lower end of the property market fell over, this meant also as well, there were less and less clients moving up the chain. So the next phase of the property market was also on hold. So the first stage, the first time buyers stagnated, gave back their properties. The second time buyers or third time buyers, so as the first time buyers didn't move up the chain, the second time buyers couldn't move up to the third time buyers, and the whole chain stagnated. And again, due to the combination of factors that now banks were giving these properties away for 10%, 15% cheaper, the whole market burst, the whole bubble in the market burst. So what basically then happened, of course, is something had to give, and of course, it's the prices. And something else also happened as well, liquidity. As banks became huge property owners, they then struggled with liquidity, because it's typically the liquidity that's coming in from the mortgage payments that allows the liquidity to go out. So what then happened, of course, is they weren't lending. So they tightened up all their lending. Suddenly people who could afford a mortgage couldn't then get a mortgage. So again, this stagnated the property market as well. So the whole property market, it was just this vicious cycle. It wasn't one particular thing. It was a number of factors that caused the 2007, 8, 9 property market to crash. However, something else happened as well in terms of the rental side of things. What we noticed at the time, rentals began to increase, because as first-time buyers struggled to get on the ladder, and banks started selling property off cheap. These were then snapped up not by first-time buyers but by landlords. So landlords snapped up these pretty cheap, because typically second, third-time landlords had the money ready. The buy-to-let market wasn't as renowned as it was now, but they had the money. So what happened? They snapped up these particular cheap properties, and through banks, through auction houses, and this is really the catalyst for the buy-to-let boom that we've seen over the last sort of decade. Now, what we then have seen is property prices dramatically increase. This obviously has increased the fact that more buy-to-let investors have got onto the market, and therefore we're now in this cycle where we're pretty much going to probably come over the next sort of decade or so a nation of renters, like Spain, like Germany. And it's not unheard of to see 35, 40-year-old individuals renting, or potentially even taking over the mortgage from mum and dad. So this is a norm on the continent. Here it's drilled into us, get on that property ladder. But again, on the continent, it's not. A lot of them are nations of renters, and it might get to the stage here where that's the way it becomes, especially is because back in say 2007, 8 and 9, we saw a dramatic increase for rental demand, simply because first-time buyers were a little bit reluctant to get onto that market, so they rented longer. So that then, of course, put more pressure on housing stock, and this is what kick-started the buy-to-let boom. So what can we learn from this? So first of all, the rent. The first thing that we can see is in the past dips, when there's times of uncertainty, both on a macro and a micro level, more people rent. So by macro and micro, I'm talking about, as I say, as a country, if we make less money, or as an individual, we have less money in. What we saw in both of those particular scenarios, dramatically, the demand for rental properties dramatically increased. And as I say, it's the first time buyers who are in there gain the most amount of growth and garner the most amount of rental income. Importantly, as well, this is something that I feel has been missed. This is the second lesson: is the overseas buyer. Now, if we go back even to February, this is before lockdown, we've got the overseas buyer purchasing at a £200,000 property. On the euro, it's 240,000. USD, it was 260. Hong Kong dollar, just over 2 million. And in the UAE, the Arab dirhams, talking about close to a million dirhams there. Come March, now March was the time when we were telling people to snap things up, get involved, because this is where the best deals were being offered. And we know it takes a brave person to go in and buy when everything's falling around you, but that's when you get the most amount of deals, the most amount of offers. If you bought the same property a month later, you would have saved 11%, or going up to 12% on the AED, but roughly, give or take, 11% on the property price, just within 1 month. Plus, on top of that, if we got a 5 or 10% deal, you got a 20% saving over a month. We've already seen that the pound has strengthened. The pound has strengthened over the last couple of months or so, and of course that saving in July has now dipped. So at the time of writing, when this was done, the saving was only 8%, or even going down to 4.54 on the Hong Kong dollar. So what I would say to anyone who's overseas is it's worth paying attention to that pound and trying to get the deals. The deals, again, we're not going to mess people around. They're running low. Typically, the deals that we got in March and April, they're not on the table anymore. There was one particular client, I remember, he was an overseas client, with his saving on the actual exchange rate, plus he bought 3 particular units, he saved 25%. Now that's a phenomenal rate. He would be saving nowhere near that at the moment. 25% in a month saving. And that's because developers were willing to do deals. Now the property market has turned, they're not as willing to do the deal. So what we try and do as a company, we try and amalgamate all of our clients together. So let's say we've got 10 different clients all looking to buy in a week. We will go to the developer with 10 units and say, look, we want a discount on all 10, and we'll try and split that across. We tend to find that that's a better way of doing it. However, we don't have the same deals that we had back in March, simply due to the fact that the market's been really buoyant. We actually did a webinar back in March. It's well worth taking a look. All of the newspapers were talking about 20, 25, 30% crash. We just didn't see it. Again, we hold our hands up if we were wrong. We would have said, look, you know what, it's something that we didn't predict, but we just didn't foresee it. We've been fortunate in the sense that stamp duty holiday has come at a good time. Therefore, that might skew the results a little bit, but we just didn't see that the property market's dipping, and it's not. We're having, in terms of transactions, I think I read a report this morning where I can't remember whether it said it was 25% up, year on year in terms of transactions, and the property prices have increased as well. So we're definitely going in the right direction in regards to the property prices. So in terms of overseas buyers, I would say it's critical to get in not only at the right time, but also the right time from an exchange rate point of view as well. In terms of timing, as I say, no one predicted COVID, or very few, I'm sure, but very few people predicted COVID, but it did present itself an opportunity. One thing that we always said is back into 2007, 8, 9, when the stock market dipped, when the property market dipped, that was an opportunity. It's the brave that delve in those particular times. It's the brave that went in 2003 when the stock market crashed. It's the brave that went in sort of 2008 and 9 to the property, and when the stock market crashed then. But as I say, a lot of people, the biggest reason why people don't invest is that we hear, I'm going to wait for things to get better and then I'm going to invest. I'm going to wait for things to get more stable and then I'm going to invest. But what we say to everyone, that's the wrong way to think about things. You want to be investing when everything's going wrong around you, because that's when you get the best deals, because you know things are going to recover. So in the property market, we don't, as long as you're buying decent city centre properties, we're not going to see those properties go to zero. As long as you've got that safety net, then okay, maybe if it dips an extra 3 or 4%, it doesn't matter, but your upside is so much greater than that. You don't want to wait for things to get better, and as they start to get better, and you're going to be paying more money. So I understand the comfort reasons why you want things to get better, but it just doesn't work. Again, over the years, the stock market crash, whether it's been the late 80s, 2000, 2003, 2008, if people that bought in those crashes made the most amount of money. Even if you look back in March this year, in March it went below 5,000 points. It would have taken a brave person to buy below 5,000 points. People would have thought it would have gone down even further. But if you bought at that level, you'd have made 15, 20% on the stock market alone. But again, in the property world, things take a little bit longer to come to fruition, but we still feel that there's deals to be had. But still, anyone that's potentially looking has missed out on those March opportunities. But again, there's still certain deals to be had. Importantly as well, what is the cost of waiting? We say to everyone, the cost of waiting is normally pretty dramatic. A lot of people we've had over the years have waited, months, maybe going on years to get a property. And actually, what we always say to people, what percentage do you think you're going to gain from waiting? Some people say, I might benefit 5%, or the property market might fall by 10%. Well, even if you benefit by 10%, the reality is after 18 months, you'd have got that back in your rent anyway. So there's actually pretty much no gain from waiting. How long do you think it will take as well? Some people say, I'm happy to wait 2 or 3 years for it to dip. Again, you've lost out on rent during that in that particular period. So what we always say to people is, look, emotionally, it is tough to buy during those times and during those dips. But what I would typically say is the market will just carry on. As long as you're not looking to make a quick sell, where you sort of buy and sell in a really short space of time, and you're holding for a medium to long term, you've got no worries about any dips that you're going to encounter, because you will encounter dips. The reality is I do feel that the property market will drift slightly, probably in 2 to 3 years. I feel that on a national level. I don't feel that's going to be sort of dramatically in city centres, but I do feel on a national level we'll see it dip. But again, what we have to look at as well now is the stamp duty holiday. What advantages have that given us? And again, we'll still have people who wait, but the majority of the time, the cost of waiting is far greater than the benefits of waiting. So that's something that you always need to factor in as well. Now, in terms of the property market versus the stock exchange, again, history taught us that the economic factors haven't affected the property market as much as the stock market. The stock market is sensitive to outside factors, the bubble of 2000, the Iraqi war of 2003, crisis of 2008, COVID. Dips have not taken their toll as much on the property market during these particular periods. We've only seen one particular dip, which is the 07, 08, 09. This was because the property market, as I say, we always say the same thing, is based on fundamentals. So the fundamentals are, for us, we say this on every single webinar, and I can't keep drumming it in enough. It's the taxation, legislation, and mortgage liquidity and rates. Let's take the taxation. Let's take stamp duty. That is the form of taxation that we talk about. The fact that that's been lifted and stamp duty holiday, we've seen that this is affected. This is one of the fundamentals that affects the property market. You increase taxation, the property market decreases. You take away taxation, the property market increases. So taxation gets taken away. We've seen that fundamental change. Therefore, we've seen a dramatic change in the property market. Nothing's changed on the legislation side. Mortgage and liquidity and rates, well, they've increased slightly. Liquidity rates have increased slightly, I should say. Liquidity has come back slightly just due to COVID, but we expect to see these over the next sort of 3-4 months picking up nicely. So we don't expect to see any dramatic changes in liquidity like we did back in 2008. So we still feel that there are deals to be had. Have you missed out on the deals in March? 1,000,000%. Yep, it's too late for those now. But the reality is that we still feel that there are great deals to be had. Timing is key. Working with a good broker is key as well. It's not about phoning us and we just throwing anything at you and hoping that you just pick up on something. It's not about that. It's about what we're trying to do is try and be as bespoke as possible. We think about you, your time frames, your age, how long you're looking for. Is it for 5, 10, 15, 20 years? Is there factors, for example, you're looking at higher income, money for children, grandkids? Are you looking for high growth so you can release equity down the line? All of these factors we take into consideration. Something for you. So, a resounding answer is, and again, this isn't us being biased because we're in the market. If we thought that the property market was going to struggle, then of course we need to look at bigger deals. But the reality is you've all seen it. You all saw 3-4 months ago the negative reports that you had in the paper, and 4 months later we're actually at a higher price than what we were 4 months ago. So all of that stuff that we read, and we had a webinar on this, all that stuff that you read in newspapers about 30% dips this year hasn't taken its toll. And of course we're going to see reports that say, oh, well, this stamp duty holiday is putting off the inevitable. It's putting off the dips. We're always going to have the negative reports. Is it putting off certain dips nationally? Potentially. But the reality is I do feel that nationally we probably need to call the market down. But I still think city centre, you buy a great unit in a city centre at the right price, you've got a great income over the years. And typically, has anyone ever seen a 10-year period where property market has decreased? I haven't. So again, as long as you're holding it for a medium to long term, I think everyone's going to be absolutely fine. So I'm going to hand over to you guys. So in terms of questions, guys, what kind of questions have you got? So I've got a few here. Will there be any notes? No. What we'll do is after this, we're going to send this through as a recording. So we'll send this out to everyone. This will be available online to view as a recording, guys. Let's have a look here. Okay, yeah, someone's just asked for another recording as well. So yeah, that's going to go out. Next question. In regards to city centres, what would you recommend? Would you recommend London still? Again, London, our view hasn't changed on London. We still feel London is still not right for the picking. One of the fundamental reasons we feel it's not right for the picking is due to the fact that the property market in the area is high, but also the reason why it's high is whilst overseas clients are still getting great rates, they're the ones who are getting the preferential deals. And of course, when we're talking about London at £8 to £1 million, if they're saving 10% on their exchange rate, that's a lot of money that they're saving. That totally takes away the taxation side. The 100 grand stamp duty that you get on a £1 million property, that's covered that off, them saving 10%. So that market for me still isn't right for the picking. I do believe there are going to be deals to be had, but it's just about biding our time there. In terms of the right cities, I would still say your Liverpools, your Manchesters, your Leeds, Sheffields, those kind of areas. Manchester has been fantastic. We feel that it's really strong market, especially because what we don't want to do is go for cities, secondary cities, where you may have furloughed workers who may not be going back to jobs. We have to take that into consideration as well. Things like maybe boutique coffee shops, baristas, receptionists, those kind of people who may struggle for jobs. That's the reality of it. So they're more likely to live in a secondary city rather than pay premium city centre prices. The people that can afford to pay premium city centre prices, that's the market that we're aiming at. What's your thoughts on off-plan developments? Again, I personally, what we're doing now is, my favourite has been off-plan developments over the years. I have bought more off-plan developments than I have developments that are ready now, simply because there's typically bigger discounts to be had. However, there's one spanner in the works there. Since the stamp duty holiday has come in, of course, I understand people want to be completing on their properties prior to the stamp duty holiday closing. So what I will be doing, and what I'm doing with certain developers, I'm going in and asking, look, if the development overruns, or if the development is already planning to be after March next year, then I'm asking for certain discounts to be given based on the stamp duty holiday. and we tend to be getting a positive response for it. People, they understand, look, it's all about how a client gets the best investment. So I think off-plan developments are spot on. I think that that's where you get the best value for money. I think you get great income because people want to live in those recently done up or new developments. But also you have the least amount of outgoings because everything's new and you've got the 10-year guarantees. You have the least amount of outgoings. So again, your profit margin is a lot higher. So I would say, yeah, those particular developments are still definitely ones to look at. But again, speak with us and ask us to negotiate on your behalf. That's what we do. When you say medium to long term, what are you talking about in number of years? Again, unless you're looking at property for a good few years, 3 to 5 years, I wouldn't bother looking at it. I certainly wouldn't be looking at property for 12 months, 24 months, things like that. It's tough to make money on it in that short space of time, unless you're getting something that's off plan that you can flip, by the way. But if you're getting something that's ready now and you want to then sell it, by the time you've paid potential stamp duty and got the property into the right place and rented it out, the chances of you then paying agents' fees on the sale and making a decent profit is slimmer. And again, unless you've got it at a great rate at the start. However, typically I would say that the property market, and also what we've got to look at as well, is the property market isn't as liquid as the stock market. A stock you can sell in a day, 3 days later the money's in your account. It doesn't work like that with the property market. So you want to make sure that you're in it for the medium to longer haul. So I would say minimum of 3 years, but I would ideally be recommending 5 to 10 at a minimum. And most people who have a property or own a buy-to-let property have had it a minimum of that anyway. What cities would I recommend and avoid? As I said, I'd pretty much recommend the main cities, whether that be the Manchesters, Liverpool, Leeds, Sheffield. I would just avoid certain secondary cities where I feel that the market isn't as strong. When I say the market, I'm talking about the job market. If the job market's not as strong, then of course we're gonna see some implications in that. What are my thoughts about the 2020 tax changes and their impact on the buy-to-let business? Yeah, they've been great. We're probably on track to have one of our biggest months. Probably in comparison, we're talking about when the new stamp duty came on. So when the new stamp duty came on back in, I think 2016, we had a huge start to the year, and it's very reminiscent of those times. So yeah, again, I think that the stamp duty changes on the buy-to-let world have been phenomenal, and we've seen a huge increase in inquiries, and again, a big increase in the amount of transactions going through this month. How would you business, travel and holiday affect renting in cities like Manchester? Again, I don't think it's going to affect renting for normal long-term rents at all. I think it will affect short-term rents, but I do feel that over the next sort of 3-4 months, that the short-term market will bounce back. We've already seen a big bounce back on holiday lets for the summer on coastal areas, but I believe in business areas that will bounce back just after the summer. But in terms of your normal day-to-day 12-month rentals, not affected it at all. We've put I'm up in Manchester today, actually. I'm driving up a bit later on. We've got some properties to rent, and we had well over sort of 300 inquiries now for a handful of rental properties. So I don't think there's any implication at all, or any indication, I should say, about rents dipping or not having the uptake. Do I think there is a possibility of city centre apartments that are dependent on offices, that rental demand and prices drop due to the shift in demand of out of city centre living, with many offices restructuring to work from home? Yeah, a good question. Yeah, I think if if your property is typically like a 3-bed and you're aiming at maybe like a young family or couples with a family, then yes, I do. I think that if they don't have to go into work, I agree with you. I think that they're going to be looking for young families with a garden, but that's something that we would never aim at. We don't look at the 3 beds for investment purposes. We are typically a 1 to 2 bed to young professionals who want to be in the hub of it, in the city centre, and by restaurants, by bars, not the sort of young family. Again, that's typically the suburbs are the best for that. But yeah, I do. I think if you've got a 3-bed now, city centres, I think that a lot of those we might see a bit of a lack of demand. So yeah, agree with that. What is the taxation on rental income for non-UK residents? Again, I have to say, legally, I'm not a tax advisor, so I can't give that advice. What I would say is it depends on the country that you're in. It depends on if you've got a dual tax treaty. And again, there is something called an NRL1. That's an N for November, R for Romeo, L for Lima, 1 form. Check into that, because if you've got a dual tax treaty, you can do an NRL1 form, and that means that you can have the same tax breaks as a UK national. Would I invest in a commercial property? That's a really good question. We tend to get that quite a bit. Would I invest in commercial property? No. Commercial property has predominantly been a really good constant return. But there are different kinds, of course. So would I be investing in a shop front? Certainly not. I think the high street is struggling and going to suffer from COVID. So I definitely wouldn't be investing in a shop front. Offices, I feel, well, let's go back to a couple of questions ago. I feel that, and again, I know the office, we work out of Canary Wharf, and I know the office there, typically you would have 400 or 500 people on a floor. We've probably got 50, something like that. So, I feel that those type of commercial offices are struggling. But then we've got the warehouse kinds where people still need to do the big, larger warehouses. Potentially that will increase because there's more spaces. People still need to manufacture stuff. So as space, more space is required, they need more warehouse space. So maybe that's the kind of commercial. But I would typically say, no, I find commercial property is more temperamental. It depends on so many factors. I typically would say residential is the more consistent property, because everyone needs to live. The reality is, regardless of what happens in an economic sense, in the high street, in the office, everyone still needs a property to live in, whether that be they own it or they rent it. They still need a property. They still need a roof over their heads. That's probably what I would say is the more secure investment. Good question. I'm BN. I don't know what that means. Sorry, but all my income is overseas. How can I apply for a mortgage in the UK? Again, I would try and go through HSBC. Typically, they're good for some overseas nationals. It's not a write-off. What I would do is I'm going to send you my email address now, and let me know a bit more about your circumstances, and we'll put you in touch. I'll send that to everyone, and I'll put you in touch with a mortgage broker that might be able to help. Let's have a look. Where were we? What about delays in construction off plan? Yeah, that's true. So in potential delays, construction off plan, that's why we're trying to look to negotiate terms. So anyone buying off plan now, again, we can't do anything for anyone who's purchased off plan already. They've bought at that price. It's a bit like saying, well, what if the prices dip? Or the client, theoretically, the seller could also come back and say, well, what about the fact that the prices have increased over the last year and a half? Are you going to give us that? Well, the answer is no. So, of course, in terms of the potential delays, that in regards to the taxation, that's something we've got to live with. But anyone who's looking to buy now, we are looking to negotiate the stamp duty. I thought stamp duty can be settled before the completion of an off-plan development. No, unless you've got a contract which theoretically completes and then they have first charge on the property. There are those type of contracts. The answer is no, you'll pay stamp duty on completion. Is it a good time to buy holiday lets? I wouldn't be buying on coastal areas, although the summer months is going to be really booked up on the UK side. I would still be buying holiday lets in city centres because I feel that that's going to still be a buoyant market. But I would base it on a factor of you've got two types of let. I would never just buy anything and pigeonhole yourself into one area. I would make sure that it's got, it's in a great area. For example, we've got ones in Manchester city centre or Liverpool on the docks. Again, as long as it offers the best of both worlds, so you can do short and long-term lets, no problem at all. This next one here. What about buying airspace above shops and applying for planning to build apartments? Again, that's an unknown without seeing the exact details. Again, I could show you two next door to each other. One makes great profit and the other doesn't. So that's a really difficult one to answer. Apologies. Is there a danger of overbuild of high-end flats in Manchester, Liverpool, resulting in rents failing to attract tenants? Not really. The suppliers have been pretty consistent. I think a lot of people see a lot of cranes up and feel that there's this big oversupply. Now, bearing in mind, we've just completed on a development called the Loom. Now, that had 101 units. That started 4 years ago. So it's taken 4 years to build those 101 units. That's 25 a year. So, you know, in that particular area, that vicinity, they've only built 25 new apartments per year in that immediate vicinity, within probably about, you know, just under a quarter of a mile. And again, you'll see this around Manchester and Liverpool as well. You'll see this big supply of properties, and you'll see, well, that block's got 150 in it. Maybe it has, but maybe that would take 2 years to build. So 75 units, that's not that many. So, like, you know, that's 75 people can go and rent that, when you may have 30,000 or 65,000 people in university. 15,000 of those have left, and out of that 15,000 have left, you may have 6,500, 7,500 stay in the city. So the chances of, you know, the supply dwindling, the demand dwindling, sorry, no, I don't feel that's the case. Next question here. If you buy off plan, what guarantees the development will be completed? There aren't. The reality is you have what's called a short stop date and a long stop date. The short stop date is when they anticipate completion. Long stop date is when they have to get completion done, or you get a full reimbursement of your money. What I will be typically looking at are things, for example, make sure they've got the funding. That's key. Make sure you've got funding, deposit protection, all of those things in place. For me, that's the key more than anything else. There's talk of a second wave of COVID. Do you think there'll be a further dip in property prices? Again, good question. Yeah, I think we are going to have a second wave. I think we did a webinar about this, not about COVID, but about the property prices 3 or 4 months ago. I think we said on that, of course, we do feel there's going to be a second wave, just simply because it's not something that's just miraculously gone away or we've got a cure for. It's something that, for me, it was all about getting prepared and putting off the inevitable. The inevitable was going to happen, but I think we were just prepping for that. Do I feel it would affect the property prices? Again, I feel that in a positive way, people are going to want to find their maybe their forever home is what they'll call it now, but obviously they'll move on. But I think they're going to want to find places just in case. I don't think we're going to have a lockdown. I don't think as a country we can afford another lockdown like what we've just seen. We've seen them do pockets of lockdowns. I think probably that's the way that we're going to see things going. Again, I'm no expert, of course, but I think that makes more economical sense to see small pockets of lockdowns rather than big national lockdowns. But I think COVID's probably something, from what I've read, is something we're going to have to live with. It's something we're going to have to adjust to and adjust in our everyday lives when we come into contact with people. But again, I don't think it's going to affect the property prices. As you look on the left of your screen, it's not a fundamental. It's something that we need to be aware of. Do I think it will affect the stock market? Yes. Do I think it will affect the property market? No. As I say, it's not one of those fundamentals that I feel. I think that the property market is so buoyant and so strong, and people are looking now, COVID or no COVID, they're still looking. We've had huge influx of people coming in to look, and also people buying. That no, I just genuinely don't think a second wave is going to perturb the property market at all. Do I rent out a serviced accommodation? If you mean do we offer that service, then yes, we do. Any thoughts about Brexit? This issue seems to be overshadowed by COVID. Yeah, really good question. Brexit was one of those things that suddenly died overnight. Everyone spoke about it for years, and then suddenly, started this year, we hardly had any calls about it at all. Again, no, I didn't think it would affect it at the start. I think, you know, we look at Europe now, they can't agree on a bailout package for COVID. We've got a number of countries, whether it be France and Italy, and talking about 750 and we've got the certain countries turning around saying no, they don't want to bail out, the Netherlands. So no, guys, I don't think that Brexit is going to affect it. Again, I always go back to the fundamentals. You know, if people can't afford to buy a house, then typically they rent. And the reality is, Brexit or no Brexit, do I think it will affect things on a micro level to some families? 100%. I do. I think that it's going to have a certain effect. But I also think that this is where the city centre apartments come in. If you buy city centre, you've got good apartments rather than cheap houses or cheap apartments on the outskirts, where you tend to get workers who are more at risk of being made redundant, or more at risk of COVID or Brexit affecting them. I think that's what you don't want to buy, the outskirts. As long as you get city centre apartments, no problem at all. Next one. What do we think about purpose-built student flats? Again, purpose-built student flats are good. It might be the fact that some students come back later in December, but I think as long as you've got a good apartment in a good area with a good management team, then no, I think it's going to be great. We don't feel that you make as much growth on the student property. They are typically an income generator, but no, I think they're going to be fine. And there's a lot of talk about doing virtual lessons, but if I'm honest, guys, I think that the virtual lessons will wane slightly. People want to be in front. They want to speak to the professors and the tutors. So I think that students will come back in droves. May have touched on this already, but where would you say we are in the 18-year property cycle? Are we in the boom period? No, I think that the boom period's been had. I think we needed to get involved 4 or 5 years ago for that. I think we've just had a pocket of a period where we should have invested. So anyone out there that hasn't invested over the last few months, I feel that was an opportunity missed, if I'm honest, especially going back sort of March. And a few of them, a few of those deals we got in March, we've managed to get clients on recently. We had a couple of properties. Vulcan Mill was one where we were getting phenomenal discounts, the block, and St Anne's, a few projects like that where we got some great discounts. But again, a lot of those discounts now, a lot of them, like Vulcan Mill, it's a fully sold out development, and a lot of these projects now are literally back up to where they were. So 250, 260 for a 200 grand property that we were getting. So I don't feel that we're in the boom period where we can say, we're still going to be going up 8, 9, 10% per year. I feel that we're still steady increases, 3, 4% a year. As I say, I feel that the boom periods has gone slightly. But what I do anticipate is still a strong market based on the fundamentals. Again, nationally, I do feel that we're going to struggle over sort of an 18 to 30-month period, but I still feel you've got a city centre, going to be fine. Next question. What are the risks to the 12-month assured rental schemes that are often part of off-plan deals? Yeah, I think that there's two risks there. There's the risk that you don't get paid, and there's the risk for the mortgage. Typically, with the mortgage side of things, mortgages are tougher to get on the assured rental schemes. So that tends to be why we avoid them. Depends who you've been offered the assured rental by, and how much is in terms of if it's a risk that they're going to pay you or not. So I can't comment on that particular one. Personally, I would say the guaranteed rental schemes is a way of dangling that carrot. I would say, look, just do your research on Rightmove, Zoopla, make sure you can get a certain type of rent in, and go off that. Go off what rents are going for now, rather than someone promising you 10% for 10 years, which typically doesn't always materialise. Apologies if I missed this already. Have you got any thoughts of buying a city centre apartment without an EWS1 form? Yeah, I think as long as they've got things in place. EWS1 form, guys, for those who don't know, this is all to do with the cladding. So there are a lot of developments out there which has got cladding. They have to send that cladding away to test if it's combustible or not. Now, this is normal. It's nothing to worry about. It's nothing to panic about. But it does depend on the development, because if you've got a huge bill that might materialise, that will form part of your service charge. So anywhere where we've had cladding issues, and we have, so anywhere where we've had cladding issues, we've always gone to the developer and said that needs to be done before completion. We're not going to have service charge fees after. Or if it's going to be done in 18, 24 months' time, we will knock X amount of pounds off the price. There's also a government scheme now for these cladding issues. So what I would always typically say is the cladding side of things, a lot of the government schemes are going to these projects where they need to change the cladding ASAP. So I wouldn't overly worry, but it does depend on a case-by-case basis. Again, more than happy to have a look. If you send me an email, let me go to the last screen here, and you should be able to see my email. So if you want to contact me, please do. I'll take a look at that scheme for you, no problems. I bought an off-plan apartment in Manchester 2018. I had the stamp duty settled already. I've got the land registration document. The development is still under construction as of today. Okay, there was, I don't know what company you dealt with, but I'm guessing this may have been a Fortis development, because that particular developer, that's how they did the contract. So what they did, this is where they completed, and then they took a first charge on the project. So if it that they're the only company that I've known in recent times to do that. So you would essentially complete, you would then pay your stamp duty, and then they would take a first charge. So if that's what you mean, then yes, there is a possibility of doing that. Some developers are open to it. So if you're looking at buying another one, and then further down the line, then having the first charge, so you could complete now and qualify for the stamp duty holiday now, then yes, that is a possibility. But it was Fortis that, as I say, were the forefront of this. But it then added further complications down the line. There was less protection on if it didn't get built and things like that. Well, look, guys, that seems to be the end of the webinar. I appreciate all your guys' time. I hope we had a really bump a lot of people turning up today. So it's good to see a lot of names here. So if there's anything else you need, let me know. My details at the bottom of the screen. This will be put on our website over the next few hours or so. It'll also be emailed a link to everyone as well to watch again. But I say the thing to take away from this is take the opportunities whilst they're there. We always say to people that it's not just about being pushed into something and sold something. We know there are a lot of companies out there, send you information, hope for the best, and they'll just literally batter you with emails day in, day out with different properties. Hopefully some sticks. It's not how we work. We want to take more of a bespoke approach, find something that suits, make sure it fits you at both medium and longer term. And then, as I say, and then we go asking the developer for deals, because there are still deals to be had. Okay, as I say, March was a great month for deals, but I still believe, and I'm personally putting money in myself. As I say, it's not something that I tell everyone else to do and don't do it myself. I'm personally still investing in the property market, and I wholeheartedly say that I think we've still got a great run ahead of us because the fundamentals are still there. The fact also that banks need liquidity coming in, and of course interest rates, and of course governments want to promote spending. I think that the Bank of England is going to keep interest rates low for a long time yet. And again, that promotes loans, that promotes spending, that promotes borrowing. So all of that factored in, I think we've still got a great run to be had in the property market. Take care, guys. Have a lovely day. And anyone needs anything, just give us a call at any time. Take care.